Hi, this is Luke Gromen, FFTT. Hope everybody had a great weekend. Happy New Year 2022. Off to hopefully, well, it has been a very interesting start so far to the year. We would say a lot of volatility. So with that, let's jump in here. From the first question is from Craig. Powell, as head banker for all the private banks, so far has used words to get bank stocks to the highs and destroyed crypto valuations. Big win for Wall Street. How far can he push this before words aren't enough to stymie inflation and his actions lead to lower bank valuations? To me, I think Bitcoin, I think I've said this before, Bitcoin's just the last functioning smoke alarm or free market, really. And so to me, what I'm watching happen to Bitcoin in particular, crypto more broadly, I think is what will happen to the economy and the banks if the Fed doesn't back off soon enough. And so in terms of a signal, I think we need to watch some of the, I think we have to watch the high yield market. I watch the ETFs JNK and HYG as proxies for that, and I'm watching for them to start really breaking down. We've seen them start to roll a little bit, but it's still very high levels. There's no real alarm there, but the thing about them is when they go, they go. So I think that's the first, I think that is, I think a key thing to be watching in terms of when will the Fed's actions begin to stymie bank valuations. So it's really when it goes from trying to stymie inflation to the actions trying to stymie inflation starting to cause problems in credit. And I think when it starts getting when it starts causing credit problems, that's when it probably starts to impact bank valuations. Next question is from Aranis. One, will the Treasury market throw a wobble again as a result of QT? Or is the Fed's standing repo and FIMA facilities stabilize/centralize these markets enough for them to not cause a problem? And number two, if not the repo market, then where can we expect to see signs of stress at the earliest? To me, these are very important questions. Thus far, there, as of last week at least, been no uptake of the Fed repo facilities. In other words, nobody's hitting those windows yet needing liquidity. And thus far, TLT, the long end of the Treasury curve, is having a very bad start to the year. There was a great Twitter thread by Jim Bianco over the weekend on that. Total return, long bond down 9 and change percent last week. I think it was last week would have been the worst year in decades for the long bond. At any rate, the long end's having a bad year so far, but the short end's have been very well behaved. Like I said, no uptake as of last week from these domestic or foreign facilities. I think it's been interesting that gold has outperformed long bonds in this sell-off. If you would have told me that real rates were going to go, 10-year real rates were going to go up 30 basis points in 4 days like they did last week, I would have said, God, gold's probably down $50 or $100 or more. And it held in pretty well off the highs, but still right around $1,800. So despite those rising real rates. So I think that's interesting. I do think signs of stress have already started. I think when you look at what's happening in Turkey with the lira, some stress with Argentina, and then Bitcoin, I think, again, is just a very sensitive measure of liquidity, one of the last functioning smoke alarms, and one of the last actual free markets, and it's providing a warning signal. It's saying that liquidity is being withdrawn. So seen now the stock market and bond market sell off a bit, and so I ultimately think all of these things will get worse until the Fed relents. The question, of course, is how long and how much. And I think, gun to my head, I would have thought a week ago, mid to late 2Q22. We'll see. We keep getting action like last week and today. It might be earlier in 2Q22, but let's see. From PM, how many rate hikes can the economy handle? And what would be the signs they've hiked too much? 2, is it likely that raising 25 to 75 basis points over 6 to 9 months could subdue inflation down to a more palatable 2 to 3% range? And 3, how likely is a Fed policy error at this point? I'll take the last one first because I think it's a 100% chance of a Fed policy error because I think it's already started. They should still be letting inflation run hot. They should not be tightening. So we're already in a policy error. The question is, how bad will it get? For me, the first question, how many rate hikes can the economy stand? is a function of the dollar. The higher the dollar is, the less rates they can tighten. Now, the challenge is the more they tighten, the higher the dollar is going to go, right? So if the dollar as measured by DXY is at 100, I don't think they can raise much at all. I think they have to be cutting. If the DXY is at 90, they can probably raise rates 2 or 3 times. And so that is the challenge. There's 2 levers there. It's rates and dollar, and how much they can do with rates depends on where the dollar is at. Signs that they've hiked too much, I think we're starting to see them already. Bond market selling off, stock market selling off, bond market selling off with the stock market. That is a big sign in my view. That is that balance of payments problem, a dynamic that we've talked about and tweeted about a lot over the last 18 to 24 months. I think Bitcoin, Turkey, Argentina, these are all warning signs. And it all comes down to when is enough in terms of the pain. Obviously not yet, but things appear to be maybe accelerating a bit based on, again, last week and today. So, and the last question was, do I think raising 25, 75 basis points over 6 to 9 months is enough to subdue inflation? Again, depends on what the dollar does. With the Dixie at 100, yes. With the Dixie at 90, probably not. Additionally, there's also a real-world economy dynamic here that the Fed can do very little about, which is supply chain problems are getting worse again. And my view is they're going to continue to get worse this year, assuming things don't get worse with COVID and some of the zero-COVID policies in China, with the geopolitics that we're already seeing start to flare up in Kazakhstan and elsewhere. So to me, I don't think 2 to 3 hikes would be enough to subdue inflation. Maybe it'll temper it a bit. But again, it depends on what the dollar does. It depends on what these external factors do. The external factors I don't think are going to get better. So I think they're going to continue to put upward pressure on inflation throughout the year. Let's see, from CT, where does one go in this environment with retirement on the cusp? Cash bad, stocks overvalued, bonds negative interest, crypto heading south, and when the rubber band snaps, providing the banks are still open, how does one protect their wealth? Gold, silver, the game can't go on. Well, the game will always go on in some form or another, right? So it's as I am fond of saying, it's what's normal for the spider is chaos for the fly. So we're just trying not to be flies. If you've got retirement on the cusp, I think you want to be overweight cash for optionality in this environment, because there are times when I have very high conviction what's in the macro in the short run. There are times when I have high conviction in the long run. I still have high conviction in the intermediate and long run on how this game is going to go. But in the near term, the Fed seems hell-bent on tightening. And so my conviction level on what the macro outlook is for the next 2, 3, 4 months is very low relative to where it has been other times in the past. So I think you want to be overweight cash for optionality. I think then you have a blend of stocks, some income-producing properties. I would prefer something that has a nice inflation hedge to it, like farmland, or maybe some niche types of rental properties. Maybe a little bit of treasuries just for some income for safety there, again, because you're close to retirement. A little bit of physical gold and silver, maybe 10%, and then a teeny little bit of Bitcoin, 1 to 2%, no more than that, because it's so volatile. You keep your leverage low. I think volatility is likely to remain elevated in coming weeks, months, maybe even over the next couple of quarters. Ultimately, though, asset prices have to rise ad infinitum to make the government's numbers and make the government budgets work. So ultimately, it's just a question of sort of managing your pile of chips, if you will, in a way that acknowledges that dynamic. From Lataro, spreads for countries in Latin America going parabolic, Chile, Brazil, or Argentina. If those countries default on their debt due to restructuring or monetization, how could it affect the commodity bull run, such as copper, coffee, etc.? Several state-owned companies extract these materials. To me, it depends on how things continue to play out and what nations might do in response. If they nationalize some of the assets, mines, etc., then I think the commodity bull run goes vertical. Particularly the sort of offshore commodity markets for those nations, right? If they start nationalizing big copper mines, that's really good for copper, in my view. You're seeing some signs of that type of thing. I don't know that happening fully. I think there's been 1 or 2, but it's more seemingly moving in that direction when you look at some of the protests and what have you. On the other hand, if they run what I would call the IMF playbook, the restructuring like you talk about, which is They devalue the domestic currency, they restructure the note, and then effectively they run production full out of the commodity to try to pay back the new restructured note. That has can be negative for the commodities to the extent that running production full out to try to drive cash flows to pay back the debt. That then ends up being a bit of a depressant on commodity prices. So you have to watch how it would play out. Personally, I think peak cheap energy, peak cheap, really a lot of different metals. I think the underpinnings of the commodity bull market remain fundamentally very strong. Obviously, we have to watch the demand side in the short run. And then lastly, from SP, do you think Powell won't cave to the market tantrums this time in the wake of rampant inflation? And if he does, what do the markets look like on the other side? Will he ever get out of the negative real rate environment? Unless he wants to cause the economic collapse that he staved off in March of 2020, he's going to have to cave, in my opinion. The question, of course, is when, right? The path matters. So I still think he's playing chicken, trying to take some froth out of some of these markets, but I've got a lot less conviction in that than I did, say, 2, 3, 6 months ago. And less conviction that he won't try to tighten, actually. I think he's ultimately going to have to cave, but I have less conviction that he won't actually try to tighten first. And you can see this starting to show up in asset prices and real rates. Even in just the last week or two, last 3 weeks, you've seen real rates spike pretty dramatically here in the U.S. and around the world. Will we get out of the negative real rate environment? Yeah, eventually. But it really, unless he wants to create the crisis he avoided 2 years ago, he can't do that until enough debt has been inflated away. You've got to get debt to GDP from the 122% it is now down to probably somewhere closer to 80% debt to GDP before you can get back to something that resembles neutral real rates without blowing up the global economy and global markets. And if they try to exit the negative real rate regime prematurely, it is highly likely they will create a debt default cycle, including in a number of different sovereign debts and other obligations. So it's something we have to watch for. If they do too much, it's good for the dollar. It's actually been decent for gold, but it's not good for basically anything else. And we're seeing that. It's not been good for crypto. It's not been good for bonds. It's not been good for treasuries. It's not been good for anything but cash. So let's watch and see what they're doing, how long it takes. I continue to think that he will ultimately have to cave, but he's playing his poker hand well for now. So with that, I'm going to wrap up. And as always, if you're interested in these updates, check out FFTT-LLC.com. You can learn more about our Tree Rings product there. 10 most interesting things every week, and runs through with how they may confirm or refute what we're thinking about, talking about, etc. In the meantime, everybody have a great week. Look forward to talking with you soon. Take care, everybody.